What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked #1 on Wall Street in the All-America Institutional Investor Research Survey. Joining the podcast this week is my colleague Stephen Gregory, who heads up the quantitative research team at Piper Sandler.
Michael, good to see you. Hope you had a great Thanksgiving.
We did. We hosted again this year. It's one of our favorite holidays to host. My wife makes the table look all pretty and the house look beautiful. I'm like a chicken with maybe a turkey with his head cut off, running around cooking. But it was good. It was good.
Not an easy job cooking. I don't know how you do it every year. And I know we were talking earlier in the week, you were saying how it wasn't as big a group this year, but what was 14 people?
Yeah. I think last year we had 35 in our house. But it doesn't feel like any less of amount of work this year. I think it's just that I doubled the recipes, essentially. So I'm still making the same number of dishes. But the turkey came out great. And I stand by what I think is the simplest and best recipe, which is the New York Times recipe, or one of them, which is a simple dry brine for 2 days in the fridge, just salting it up, letting it sit in the fridge for a couple days, bringing it out, letting it set to room temperature. And then I threw some apples and onions in it, some what other lime, salt, pepper, a little butter underneath the skin. And I think at 450 the recipe calls for, but we used the convection oven. So you're supposed to bring it down by 25 degrees. So at 425, and it was a 23-pound bird, 425 for half an hour to get the skin nice and crispy. And then you bring it down to 350, and in this case, 325. And so I didn't know how long it was going to take, and I'm assuming it's going to be another 2 hours. So I set an alarm for an hour. So that would be a total of an hour and a half. And at that hour mark, I pulled it out, and it was done. Perfect. So I was surprised that it only took an hour and a half to cook. And I was also fortunate that I pulled it out at that time, because any more time in the oven, I would have started to overcook. So yeah, it came out perfect. And everyone's always amazed, but like in many things in life, just keep it simple.
Yes.
Nothing fancy.
You need to get one of those wireless Bluetooth thermometers.
Yeah, that's probably, I should.
I have one there. Phenomenal. Maybe for next year.
Yeah, that would save myself from popping in it, pulling it in and out. But this year was one and done. So, but yeah, maybe I'll put that on my holiday list.
All right. I know what to get you this year. So that's great. Congratulations for surviving that. I still think 14 people is a large crowd, but I guess you can handle it. A crafty veteran.
Yeah.
So Thanksgiving is over. We're now moving into the home stretch of the year. How are things looking? What are you keeping an eye on these days? There's quite a bit going on in market.
Yeah, I figured this week we'd talk about our HOPE framework. HOPE, Thanksgiving, has a nice ring to it, of course. And I think it's what I see and throughout my HOPE framework. And for those of you not familiar with it, it's a simple acronym, H.O.P.E. Each one of those letters stands for a segment of the economy, and it's how we look through where we are in the macro cycle and think about positioning. Housing is the H, O is orders, P is profits, and E is employment. And, what's interesting is that we've been in this very elongated, slow moving cycle. The debate in 23 and debate in 24 was whether or not we were going to have a hard and soft landing. And people aren't really having that debate anymore. The focus today is more really on a K-shaped economy. So I don't know if that implies from those folks that we've landed or not. We certainly haven't had a recession. Our work suggests we're not going to go into a recession or what we would describe as a broad-based economic downturn. But there's a lot of focus on the E and employment, certainly in the second half of 2025. And our message has been for a couple of years that we're going to see softer employment, but that would be a good thing for equity markets. So perhaps we can talk about that.
That sounds great. I think would be a good conversation for today, in that that K-shaped story. And then I like how you've been talking about a lot in the E-shaped. We've had a, generally speaking, K-shaped economy for what?
Ever.
30, forever?
Forever. Yeah.
So to break it down, maybe talk a little bit about that. I think that would be a great segue into what you're seeing. Like, what is this E-shaped economy you've been talking about?
Sure. So I think we've always had a K-shaped economy in the United States. And really it's been exacerbated massively on both sides with the rise in asset prices from housing to equities, helping lift the top leg of the K, and really the lower leg of the K, which doesn't own as much assets and really bears the brunt of both higher interest rates, economic uncertainty, and of course, the price shock that occurred in 2022. And I think this is going to really persist because it's really hard to get out of a affordability crisis that we have today with those that are at the lower end income spectrum, because you've had such a sharp increase in prices, and it certainly affects people that don't have savings quite a bit more. And while lower interest rates and lower energy prices at the margin can help, this isn't pre-COVID where prices and inflation were not so elevated. Their consumers had more discretionary spending power. Now we've had this massive shock. So it's going to take a lot more for the lower bottom part of the K to feel better than just lower interest rates or lower energy prices and things like that. So we've really tried to describe it as an E-shaped economy because at the end of the day, I think what drives the business cycle, people always ask, is it the wealthy spending money or is it the high propensity of people at the lower income spending money? And I think obviously those both matter. At the margin, I would say the biggest swing factor is probably right there in the middle. And the analog I've tried to make is with an election. Think about the election cycles, the presidential election, the last two election cycles in 2020 and 2020 into 24. You've always had people on the far right and the far left, and they don't really determine the election because typically those people stay where they are. You don't see too many people going from the far right to the far left in terms of their political views. But in the middle, call it your moderate rights, moderate lefts, and independents, they can be swayed. And I would say that is what often determines the outcome of the cycle. I would say the middle went to the left in 2020. And in the last election, when President Trump won, the middle clearly moved over to the right. So that's what I think about the economy right now. And I think that's really what ultimately determines the cycle. It's those parts of the economy that benefit a little bit from what helps the upper end of the K with asset price increases, but are also sensitive to changes in prices and changes in interest rates, and where these incremental changes can incrementally shift that middle, which could mean a better, broader economy or a weaker, narrower economy. Looking ahead, we think that middle, while it's been very weak for the last few years, we do see some signs of healing in 2026.
So another way of saying that a cyclical pickup or a cyclical downturn would really affect that group. They're going to be a little more sensitive to a pickup in the overall economy and benefit from that.
Yeah, I think so. And that's where some of the policy stimulus that we were getting in 2026, whether it's from the lagged effect of lower rates or the increase in tax returns we're going to see in the first half, these are things that I think could show up as a positive. But what's been tricky, and I think will continue to be tricky, is when we learned this a couple of years ago, is that there's probably still going to be a lot of negative data points to point to. Probably going to continue to see delinquencies in areas rise. And what I think investors have to be careful of, especially in a K-shaped economy or even an E-shaped economy, whatever you want to call it, the economy with really big dispersion between the tails, is be careful to take data points from really either side of those tails and extrapolate it to define the whole. So whether it's subprime auto delinquencies rising, that's a problem, but it's not a reflection of the entire economy. And then the opposite's true, of course. There's parts of the AI economy that are booming, which obviously do not describe the whole. So I think we have to, pre-COVID, I would argue that things were much more synchronized in the economy. So when you started to see problems arise, it tended to be pretty general. And when things got better, they usually more broadly improved. But when you're in a K-shaped economy, I think you have to acknowledge that you're going to get really good data points and really bad data points, and neither one of them are useful to explain the whole.
That's an interesting point. And one data point from NVIDIA or, as you mentioned, subprime credit is not indicative of the overall strength or weakness or the trend in the economy. I think that's an important thing. You know, at all time, every on Twitter or market pundits pointing out this one data point. Oh, look how bad things are because of this, or look how great things are because of this one thing. They're looking at the whole. So really interesting. And I really like the E-shaped. I don't think I've heard it from you recently, but I don't think I've heard that in the broader context. But it's so true. Not everything is the top, not everything's the bottom, and it's not binary. There's a granular spectrum in between. So where do you see that spectrum going? What is the trends you're seeing with the Hope framework about where that most sensitive middle part is going to be heading for the rest of this year into 2026?
Yeah, and I usually would say let's start out with talking about housing, but I think chronologically thinking about the Hope framework and where we are today, I think it's actually more useful to start the conversation talking about employment, the E, because it is a cycle. It is circular. All U.S. cycles have gone through this hope phase. And whether it's a recession or a bad slowdown, you get some softness in employment, you get rates to come down, and then that has generally started the recovery in the housing sector, which begins the next broadening of the next U.S. expansion. This year in the third quarter, when we saw a lot of negative revisions to payrolls, that big annual revision, it really shifted the consensus view on employment. For much of the last 2 years, there was a very big debate on whether the employment backdrop was weak or strong. And again, you had a lot of weak data points. The household data was very weak, while the payrolls data held up much better. Claims have been really low. And unemployment has been slowly grinding higher. So it hasn't been a fast moving data series that, really has gotten people's attention. But today, and in the last few months, we've seen some negative numbers in payrolls and ADP. The unemployment rate now has gone to a cycle high of 4.4%. We're seeing layoff announcements. So there's not much more of a debate with employment. I think now the debate has gone from whether employment is weak or strong to how weak is employment going to become. And of course, there's a lot of recession fears out there now because people think higher unemployment equals recession. That's generally true. I think, again, let's take a step back. The unemployment rate is up to 4.4. About a year ago, we were at 4.3. So it really hasn't accelerated higher. The payrolls data has been much weaker. And I think the three aspects that are impacting that, and this is always an interesting discussion, why is unemployment weak? First, I think part of it's very cyclical. We saw a sharp tightening cycle, sharp price spike in 2022. So there's no doubt there's very clear evidence that there's cyclical weakness going on in the economy. The second is probably related to immigration. Immigration has collapsed. So that has led to a fewer supply of workers and also a declined need for employment growth because there's less people. And then the third, which I haven't seen a lot of data on, but there's plenty of anecdotal stories, is the impact from AI and the lack of hiring or the beginning of firing in some companies. So I think all three are impacting the story. I think, to me, the biggest impact is coming from the cyclical issue. Certainly, we could more clearly quantify that. And when you look around the economy, the parts of the economy that are weaker generally have the weaker employment backdrop. So the impact of rising unemployment has led to lower interest rates. And when we look at where unemployment started to creep up, it was really in the fourth quarter of 2023. The unemployment had been going pretty much flat for about a year between 22 and 23 at about 3.5%. Then it broke above that and we got up to 3.6, 3.7, 3.8 in the fourth quarter of 2023. And that was what I think ultimately put in a top in mortgage rates, 10-year rates. It ended the Fed tightening cycle. It put a top in 2-year yields. And so for the last 2+ years, we've seen the unemployment rate continue to grind higher. And with that, we've seen the interest rate backdrop continue to grind lower. And so what's been interesting is that it's been a kind of a slow, gradual softening in the economy. And with 2 years now of falling to flat interest rates on the short end and the long end, a lot of our indicators, whether it's for housing, for orders, or profits, looking ahead over the next year and a half, are all signaling better days ahead. And people often talk about the long and variable lag of changes in interest rates. And that's exactly what I'm talking about. It's been 2 years now where rates have not gone up. It's been a year plus of Fed easing. So a lot of our signals in our work are suggesting that the window of biggest downside risk is behind us, and we're entering in 2026 a window that goes into 2027 that suggests that the data is going to improve. And that's housing data, manufacturing data, transportation data, the cyclical parts of the economy that are most sensitive to changes in interest rates and changes to the economic backdrop at the margin.
So softness in E, the end of the hope cycle, is begetting the beginning, hopefully the beginning of the next cycle and back to the H again.
Yeah. And, where the debates are around that today is there's obviously an affordability crisis in housing. You've got really high home prices, really high relative interest rates. So the cost to buy a home is really high, which is why the housing data has been quite weak for the last 2.5 years. On top of that, we're all humans, and there's a lot of PTSD around what happened to housing in '07 and '08. And no matter what, because of that event, it's always going to be in the back of investors' minds. So I would say the skew on sentiment towards housing is overly negative because of that. And we see housing as a potential slingshot because there's so much pent up demand. And yes, you have really high affordability issues. And everyone's focus on home prices being high and the fact that affordability levels compared to pre-COVID are so much higher. And we're not getting back to those affordability levels anytime soon, if not ever. Perhaps we will, but it's not going to happen in 2026. But that doesn't mean you need to get back to those affordability levels to see an improvement in the housing data. We're already seeing it. One of the data points we watch is the MBA purchase index. So it's a weekly composite of how many mortgage applications were submitted. And that today is at 181. About a year ago, it was at about 125 and has clearly moved up throughout 2025. And that tends to be the early, most rate reflexive part of the housing data that gets better or gets worse. So we're starting to see green shoots from purchase applications. That data tends to lead total home sales. It tends to lead permits and starts and other housing data, because usually purchase apps pick up when rates are coming down, which starts to get the whole housing cycle going. And while we do think it's going to be a slow and steady rebound, not a boom or V-shaped pickup in housing, we do have to acknowledge, even with the affordability issues, that 2 years ago, mortgage rates were almost at 8%, and today they sit just above 6%. And that's a huge rate of change. And I think that's where we've tried to point out everyone's very focused on the level of rates and the level of home prices, and everything in the economy and at the margin occurs at the margin. It's all incremental because of, as humans, we think of everything in a relative basis. So is it cheaper or more expensive compared to yesterday? If you get a mortgage today, it's 6. You feel like a genius because it was at 8 2 years ago. Now on the way up to 6, those that got a mortgage there didn't feel so good. But again, it shows you the only difference is just perception. So we expect to see better housing sales in 2026. We continue to expect to see higher mortgage applications and other data improve. And it's really due to the change in mortgage rates. And while home prices do remain very elevated in many parts of the country, the biggest swing factor in the affordability equation is indeed interest rates. And you see this when people buy a car, they don't negotiate the price as much, they negotiate the monthly payment. And we don't have to get into the horrors of that, but it's the same thing ultimately with a house. People aren't going to see if they can afford the house, look down. When people buy a house, do you think they have any clue what the total cost of that house is, which is the principal plus all the accumulated mortgage interest payments? Of course not, because that number would scare the crap out of everybody.
Mhm.
But instead, this is what I can afford per month. Can we make that work? I think we're getting closer to people's numbers. And again, with the reference bias that interest rates are lower than where they were a year or two ago, that also changes the psychology. So I think the housing data is going to surprise people and get incrementally better, not incrementally worse. And yes, that's going to take place with continued softness in employment. And I think it's important to acknowledge that employment is not falling off a cliff. It is slowly, gradually weakening. And I think that's going to continue. I don't really see a big negative macro shock that would accelerate that We don't have a spike in oil prices. We don't have a spike in interest rates. There's no massive collapse coming from a fiscal tightening. So my view would be that we're probably going to see more of the same. And those three issues regarding employment, immigration, AI, and the cyclical weakness probably will persist for a while. And you're unlikely to see how employment really improve much until you see housing and manufacturing and transportation and other parts of the cyclical economy get a little better. So I think we're in this kind of sweet spot. And I've described it as a Goldilocks backdrop where you have just enough softness in employment to give you some easing in interest rates and prices otherwise. And that is going to slowly allow some healing to take place in the middle of the economy, which hopefully some of that trickles down. And the breadth of the economy looks a little better in 2026. So better housing is often precedes better orders or PMIs. And the PMI data, which is really important for thinking about the earnings outlook, has also improved. We've seen the breadth of US PMIs when we look at all the regionals and national PMIs that are services and manufacturing. Right now, half of them are expanding. And that's roughly the highest we've seen in about 2.5 years. So underneath the surface, while PMIs have been waffling around some weak areas, and again, there's some really weak numbers. The Chicago PMI was really weak last week. 2 weeks before that, the Empire Fed survey was really strong. So again, there's not going to be a backdrop where all the data are looking perfect or terrible, but the breadth of that data with respect to PMIs are improving. And we've got a lot of different series that anticipate the trend in PMIs. They're all pointing up unanimously, which doesn't often happen, but certainly when it does, it's usually the right signal. And that backdrop of better housing, better PMI, better orders is one where earnings breadth improves. It's the macro breadth improving, which corresponds to the micro breadth improving. And that is how the cycle plays out. And so we think we're going to see a broader market next year because earnings are going to improve gradually across the market and the economy. Again, it's not going to be a boom. I can hear people be like, oh, you're crazy. Everything's terrible. This is also bad. It's going to be a slow, gradual breadth improvement, which is good. It is good for in the aggregate. If we saw an economic boom right now, inflation, commodities, interest rates would all turn right back up very likely. And if we saw, obviously, an economic collapse, we get lower rates, but we'd have much higher unemployment, which would not be a good thing. So this moderate broadening, I think, is really good news. And that's happening alongside a continued boom in AI. And that also is likely to broaden out from just hyperscalers, which has been the story for the last couple of years now, to moving to data centers and building out the architecture and all the construction and industrial production needed to create the next leg of that AI expansion. So I think things are coming together where you're going to have enough softness to offset some improvement in strength that can keep interest rates capped, can keep inflation pressures capped, and can even give us a backdrop where the Fed's able to cut a few more times. And to me, that is Goldilocks. In a post-inflation shock world, what history shows you, which is very clear, and what I mean by history is you have to go back from 1990 backwards. And in all of those periods, it was always higher unemployment that started to get rates down and the markets up as rates started coming down to kickstart that next cycle. So the fact that we're so inflation and interest rate sensitive, I would argue that the weakness in employment we're seeing from a big picture is actually more of a positive than a negative right now. And I think that will continue to be the story in 2026.
That's great. Optimistic about the economy heading into 2026. And Thanksgiving is past, but definitely thankful for your hope framework. It's such a great way to take this enormous mechanism and all of these data points and structure them away and understand how they flow through and how the cycle begins. Great stuff. Very informative. Thank you so much, Michael.
All right. See you next week, Stephen.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.